that creating a comfortable retirement is the ultimate financial goal. That's because it requires a considerable nest egg to provide a reliable income for life. However, determining how much to invest for retirement and what income you'll need can be challenging. This podcast will review key retirement planning variables, potential sources of retirement income, and the amount an average person or couple needs for a secure future. You'll learn what it takes to retire with over $100,000 of annual income. Welcome back to Money Girl. This is episode 936. I really appreciate you spending some time with me. If you haven't been here before, I'm Laura Adams, an award-winning author, a spokesperson, money speaker, and founder of The Money Stack. That's my Substack newsletter. I've been providing personal finance and advice on this podcast weekly since 2008 with over 44 million downloads. You can learn more, ask questions, and sign up for The Money Stack at lauradadams.com. Newsletter subscribers automatically receive my Money Success Toolkit with the exact templates that I use to manage my money. So I hope you'll download that and enjoy it. So why do we need to save for retirement? Well, most people are going to reach an age when they're ready to slow down or they're just unable to work due to poor health or maybe lack of opportunities as you age. A secure retirement is one that provides enough income to maintain your desired standard of living throughout your entire life. Many financial planning experts recommend having at least 70% to 80% of your pre-retirement income after you stop working. For instance, if you earn an average of $100,000 per year in the years leading up to retirement, a good target is having at least $70,000 per year to be comfortable in retirement. But I will say if you have high aspirations for retirement, like owning a vacation home, leaving a legacy for your family, or traveling extensively, there's nothing wrong with planning for income that exceeds 100% of your pre-retirement income. So everybody's goals are unique. Let's go through some typical income sources and how much you'll need to ensure you never run out of money in retirement. So before you can determine how much money you need to save for retirement, I want you to consider all of your potential guaranteed income sources. That might include a workplace pension or Social Security retirement benefits. Social Security gets funded by payroll taxes and the self-employment tax. If you're an employee, you may see the deduction for this listed on your paycheck as OASDI. That stands for Old Age, Survivors, and Disability Insurance. However, if you're a government employee or a railroad employee, you're typically covered by a different retirement system. And so you're going to qualify for a pension instead of Social Security. In addition, some large employers may offer a pension, but it's become a very rare benefit these days. If you're an eligible U.S. worker, you can claim Social Security retirement once you pay into the system for a minimum of 40 quarters or 10 years. The calculation for how much you'll receive in retirement is based on the average of your highest 35 years of earnings. Now, if you worked fewer than 35 years, that's fine, but the missing years will get factored into your Social Security calculation as zero income, and that, should bring down your average. But if you worked more than 35 years, only your highest earning years will be considered, and that will increase your benefit. The Social Security program taxes earnings up to an annual threshold, and this is known as the wage base. And that has increased over time. For 2025, the wage base is $176,100. And the Social Security tax for employees is 6.2% of your earnings up to that maximum. Plus, your employer also pays an additional 6.2% on your behalf. Now, if you're self-employed, you pay into the Social Security system at the full rate of 12.4%. So that's 6.2 plus 6.2 for that 12.4% total. Again, it's just on up to $176,100 of annual income. In any year that your income exceeds that wage base, it's no longer taxed until the following year. So everything resets in January. For instance, if you earn $200,000 in 2025, you pay Social Security tax just on $176,100 of income, but not on the remaining $23,900. In addition to your career earnings, the Social Security retirement benefit you receive varies depending on the age you choose to claim it. If you were born between 1937 and 1959, your full retirement age is 66. But if you're like me and you were born in 1960 or later, it's 67. However, no matter when you were born, you can claim early retirement starting at age 62. But the downside of claiming early is that you will receive a permanently reduced benefit. So that means it always isn't the right decision, for everybody. However, if you absolutely need that income, or let's say you've got a short life expectancy because your health isn't good, claiming early retirement can be a lifeline. It can be a wise move. So again, you really have to evaluate your situation. According to the Social Security Administration, if you fully retired in 2025 at age 66, the highest possible monthly benefit would be just over $4,000. But if you're 62 in 2025 and you choose to take early retirement, you'd receive about $2,800 per month. That's 30% less for the rest of your life. So, just to show you what it means to wait until full retirement versus claiming early. A common strategy to permanently increase your retirement payout is to delay claiming benefits until age 70. For every year you delay benefits past your full retirement age, and again, that's either 66 or 67, depending on your birthday. For every year that you delay to age 70, your Social Security payment increases by 8%. So if you retire at age 70 in 2025, the maximum possible benefit is just over $5,000. So that's about 25% more monthly income than claiming benefits at your full retirement age. So in other words, if you can wait several years to begin claiming retirement benefits, it's an excellent way to lock in a higher income for life. However, as I mentioned, that's not the best decision for everyone, so you want to be sure to get some professional guidance. Now, those monthly benefit amounts that I mentioned reflect the maximum if you were a high earner throughout your career. If you're more like a typical worker, I'm going to give you the average Social Security benefits by age for 2024. So if you claimed early retirement at age 62 last year in 2024, your average benefit was just over $1,300. It was $1,342. If you claimed at 66, the average was $1,800 a month. If you claimed benefits at 67, the average payout was $1,930, and if you delayed until age 70 in 2024, the average payout was $2,148. To learn more about Social Security and to review your earnings history and see your estimated future retirement income, you can create an online account at the Social Security website. That's ssa.gov. Everybody should do that. Be sure your reported earnings are accurate because any mistakes could keep you from receiving all the benefits you're entitled to. While many people will receive Social Security benefits in retirement, it's typically not enough for a comfortable lifestyle. Remember that the program was designed to be a safety net, not a sole source of income for retirees. So that's why investing for retirement is critical, especially if you don't have a workplace pension to count on. So let's go through 10 key considerations to help you determine how much you need for retirement. So number one is your current age. The sooner you begin investing, the more compounding interest works in your favor to grow your balance. So that means young investors can actually invest less than those who start later on in life. Number two is your retirement age. The sooner you plan to take income from your retirement nest egg, the bigger that nest egg needs to be. Number three is your current retirement balance. If you already have an impressive retirement nest egg, you may be able to save less or even nothing and still meet your goals. For instance, your investment balance will double approximately every 10 years, even with no new contributions, if you earn an average return of 7%. Number 4 is your average pre-retirement investment return. For example, investing $200 a month for 40 years with a 3% average return would grow to about $185,000. But if you received an 8% return instead, it would grow to over $700,000. To get a good investment return and minimize risk, consider investing in passively managed, low-cost funds that are highly diversified. These might include index funds that aim to replicate the performance of a specific index or financial market, such as the S&P 500. From the 1920s to 2024, the S&P 500 has risen an average of approximately 10%. And even if you earn less, you can accumulate a huge retirement account by investing consistently in an index fund. The 5th factor is your post-retirement investment return. Most retirees want to keep their nest egg growing. You might choose investments that offer relatively low returns but are considered safe, such as certificates of deposit or CDs and bonds. Number 6, your guaranteed income. So factoring in sources of lifetime income like any pensions, annuities, or Social Security retirement benefits is crucial for your retirement planning. If you're an average worker, Social Security may replace about 30% of your pre-retirement income. Number 7 is future inflation. Since inflation causes prices of everyday goods and services to rise, it can make your retirement income less valuable. And it's good to know that Social Security benefits get adjusted for inflation as the cost of living increases. Number 8 is your health and longevity. If you're relatively healthy at full retirement, statistics indicate you'll likely live well into your 80s. And if you have a good family health history and take care of yourself, you may need retirement income into your 90s. Number 9, your withdrawal rate. The lifestyle that you want in retirement and the amount you withdraw from your nest egg determines how long it can last. A good rule of thumb is to factor in annual withdrawals of 4% if you retire in your mid to late 60s. Again, that's just a general rule of thumb. Number 10, your account types. The tax status of your retirement nest egg makes a huge difference in how much you need to save. For instance, if a majority of your wealth is in a Roth account, that means your withdrawals in retirement will be tax-free. But if most of your money is in a traditional tax-deferred retirement account, you typically must pay income tax on withdrawals, and that leaves you with less to spend. So how can you retire with over $100,000 of annual income in retirement? Let's say you earn $100,000 a year now, and you want to retire at 67 with the same amount of pre-tax income for life. Let's suppose you don't have a pension, but you have paid into Social Security for decades and will receive approximately $30,000 a year after claiming benefits at your full retirement age of 67. So if you've got $30,000 coming from Social Security, that means the remaining $70,000 has got to come from your savings and investments. I mentioned that a 4% withdrawal rate is a good rule of thumb for someone in their 60s who's in good health. So if you divide your desired income in retirement by that number by 0.04, you determine the total savings needed, and that comes out to $1.75 million. So again, that's $70,000 divided by 0.04. Once you have a retirement savings target, you can determine how much to save based on your current age and retirement balance. For instance, if you're 27 and you've got nothing saved for retirement, you'll need to save about $660 per month with an average annual return of 7% to get to that 1.75 million nest egg. You can plug your information into a retirement calculator to crunch the numbers. A great website for that is dinkytown.com, dinkytown.com. Using a ballpark estimate for retirement can be useful for long-term planning. However, if you're approaching retirement or maybe entering retirement, I'm going to recommend that you work with a financial advisor to really fine-tune your plan. An advisor can help you understand when to claim Social Security, how to cut taxes, and the best withdrawal rate to make sure you don't outlive your money in retirement. I hope this has been helpful if you've been thinking about how much you need in retirement. And if you have questions about retirement, make sure to send them to me. Again, you can visit lauradadams.com to email your money question. I would love to feature it on a future show. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and I want to thank our terrific team. Steve Rickyberg audio engineers the show. Holly Hutchins is our director of podcast. Morgan Christensen is our advertising operations specialist. And Nathaniel Hoops is our marketing contractor.